You're trying to buy a house in a couple of years and you have some money, but you just quite aren't there yet. And you know that investing in the stock market can be risky, and you're planning to buy this house in 5 years. In fact, if you had invested your money in February of 2020, then you probably would have lost a significant portion of that money you were going to use for the down payment on the house because of the market decline. Where should you keep your money if you want to use it in 5 years without losing all of it, or 50% or 20%? Just, you don't want to lose any, really, that's the point. And you want it to grow just a little bit. What's up, you guys? I'm Jacob Fisher and it's Minute Monday, and today we're talking about the safest investments for a house purchase potentially in 5 years. Something where you don't want to lose any money and you want it to grow just a little bit and don't want to keep it in a checking account where you won't get any interest on it. The way I see it, you pretty much have 3 options for your money, and I'm not an investment professional, so make sure you watch this video for entertainment purposes only. The first option is a savings account, which is also a great place where you should keep your emergency fund. This is the safest place where you can earn at least a little bit of an interest, hopefully to avoid inflation through the years, while keeping your money safe. The 2 current leaders in the savings account game that I found are American Express at 1% APY and Ally Bank at 1.1% APY. That's annual percentage per year. Both savings account would be great, but Ally Bank just earns you more, so might as well choose that one at this current in time. Of course, with the Fed announcing different interest rate changes, those interest rates will fluctuate. I remember checking out American Express maybe 4 months ago, and it was a 1.7 APY, which beat out Ally Bank's 1.6. So it does fluctuate. Savings accounts, again, are great for emergency funds because you'll have access to your money right away. Nothing to wait like the next investments that I'm going to talk about. These other investments, your money has to actually mature and you can't take it out, or you'll be charged a penalty fee for taking it out early. Option number 2 is a high yield CD or a certificate of deposit. These accounts typically have higher yields than savings account in the long term. You can actually get 3-month CDs, and those don't have good APYs. But the 5-year that I'm going to talk about from American Express again has a 1.1%, and Ally Bank again beats American Express at 1.15. These are both 5-year CDs, meaning you need to keep your money invested in the CD for 5 years. You can't take it out without a penalty, but you do know it'll grow that extra little bit, just a little bit of percent per year. Now these also change. Sometimes you can find higher CDs. Apparently Georgia's own credit union has a CD of 1.7% right now. Look around for your local credit union, because I'm assuming that getting a Georgia credit union to accept you as a client for their CD isn't going to be the easiest thing to do if you don't live in that state. So check local, find a local credit union or bank that is offering you CDs. The last option is peer-to-peer lending. This one is again interesting, and I've mentioned in a previous video before, but just keep in mind that it is riskier than the other 2 investments. It also yields more. They do say that their notes return positive returns year over year, so that's at least good. How it works is that loans are broken down into notes, and you buy notes or a collection of notes, and based on the notes or collection of notes that you bought, you get a return on that. Anywhere, if you're looking at 40 notes, you have a bunch of them, you can expect a return of 1 to 8% per year. 60-month notes, which again are longer and your money will be tied up for 5 years, do return better than the 36-month notes. The 60-month notes will return anywhere from 5.5 to 9% on average. That's per year, so on average that's what happens. Now the question remains, which one of these 3 options should you go for, and how much of your money should you put into it? I think this is the most important part, is that you should diversify whatever funds that you have around. Let's say you want to put $50,000 down on a house in 5 years, but you only have $15,000 right now. You should probably split that up into 4 different ways, and yes, I say 4 because the 4th option will be in the stock market. Now I know that's very risky, and sometimes it can go down, and maybe you could lose a good portion of that investment, but it will provide good returns. Considering that, on average, you can estimate that in 5 years your money should have increased in value or at least stayed the same. The 2008 recession lasted maybe 2-ish years, and then it took another 4 years before it came back to the point where it was. So that means in 6 years your money would have done nothing. You do lose the opportunity cost of that 1 to 1.5% APY you get from savings accounts though. This of course brings in bigger risk, which is why you should use the tiniest amount of money for the actual investment account. If you have $15,000, maybe take less than an eighth of that and use that for the investments. Just find a good solid ETF that just keeps going up and provides maybe some dividends. You can check out some in the corner for that one, but a nice ETF that will hopefully grow in value over those 5 years. Something to keep in mind is that you choose to invest in 4 ways and not just the other 3, which are safer. That 4th way, once the stock market goes down and hits your cost basis, you could just sell and be done with it and then put that money into a savings account or whatever you choose to invest in. Now you can do that and hopefully you'll have earned some dividends, so your overall investment will not have been 0% over the time period that your money was in there. This hopefully protects your account while providing higher returns overall than just a savings account. Let me know down in the comments below what you think of these ideas and if you're going to do any one of them. I'd like to know. I upload videos on Monday, Wednesday, and Friday on personal finance and travel, and if that sounds like something of interest to you, then subscribe down below. Until next time.